Good morning, everybody. Welcome to a brand new week and an excellent chart just to start the week with, and just want to highlight the trappings of trying to trade divergence on the pip range charts. And this is a good example of why to be patient and to wait for confirmation, because sometimes confirmation can be the difference between entering way too soon and also getting on the wrong side of the trade. So what we have here is we have the pound versus the Australian dollar. This is the Asian session to start the day off after the weekend. So what we have here is an interesting setup. So this was the initial price action from a couple of hours ago. Price was just kind of meandering upwards, and it kept bumping into 164.65, which was also where price stalled just before the close on Friday. You can see here, just highlighting here, price dropped off. So because when you're trading it live you can't see obviously the right hand side of the chart. That would be fantastic if you could, but we can't. So what we would be looking at here, if I just keep my cursor here, if you can just try and imagine if you're blocking out the move to the right where we've seen it pop higher. Obviously there is an element of hindsight into this, but I didn't take the trade for the very reason I'm about to explain. You can see here all of these wicks, these are all bullish pin bars, and what we can notify is they're always closing above the blue line, which is the Kiju Sen in terms of the Ichimoku. So they're always closing above it, and also you can see the wicks are always touching the cloud and it closes higher. So whilst you do have an excellent setup, because if you can see here the highs are the same, but the oscillator, which I'll just draw in here, you can see here that's the setup you'd be looking at, something like that. So the price has made higher highs, whereas the oscillator has made lower highs, meaning there could be a chance of a reversal. But I did not take the trade for the reason being, you keep on looking at this price action, it keeps on going higher, it closes above it every single time, it bounces off this, and then the eventual pop higher comes. Of course, it may keep on coming down, and this trade may work out, but you would be offside around 30 pips, 32 pips at the current prices. So it wouldn't have been a great entry. So what I'd be looking for is, first of all, if this was the current setup, I'd be waiting for price to close below, and also probably just break the cloud just to give me some sort of confirmation that price has started to turn. If we look at the time-based charts, we can see here we've got the cam level, which also would have been another nice factor for you to consider in that you could go short. But as I say, you want to look for some sort of confirmation. So that's just one of the things I wanted to highlight as to reason you should always try and be careful with your entries, especially in a trending pair such as the pound versus the Australian dollar or the euro versus the Australian dollar. They can both trend very well, and it can sometimes catch you out if you enter too soon. So just bear in mind, always look for that confirmation, and let's hope for a good day today. Thanks very much.